This is the hidden war deciding every stock trade. Most people think the edge comes from better analysis or smarter algorithms. Often, it comes from getting there first. I'm a professor of mechatronics. I study engineered systems, and this one turns millionths of a second into money. Here's the machine, the bottlenecks, and where the extraction happens. Before 2005, the US stock market was much closer to the picture people still carry in their heads. One stock, one price, one main venue. Not perfect, but much less physically fragmented. Then regulation national market system pushed brokers to chase the best available price across multiple exchanges at once. That sounds fair, and in theory, parts of it were, but it also did something else. It turned one market into a cluster of separate buildings. The New York Stock Exchange matches orders in Mahwah, New Jersey. NASDAQ matches orders in Carteret, New Jersey. Those engines sit about 35 miles apart. Now imagine a pension fund trying to buy 100,000 shares of Apple. That order does not hit one place. It gets split and routed, part to Mahwah, part to Carteret, part wherever the system sees price. And the second you do that, you create a new variable. Not intelligence, not insight, travel time. The pieces cannot arrive together, not because the software is sloppy, because physics will not let them. And once the market was physically split, the edge no longer belonged only to the smartest trader. It belonged to whoever could weaponize the gap first. In 2007, trader Dan Spivey was running an arbitrage strategy between Chicago and New York. Buy in one market, hedge in the other, capture the spread. On paper, elegant. In practice, broken. He was not losing because the idea was stupid. He was losing because the signal path was. The existing fiber routes had been laid along railways, highways, and legacy rights of way. So the cable between Chicago and New York did not run straight. It curved, it detoured, it took the scenic route. Round trip time was roughly 16 milliseconds. In everyday life, that is nothing. Inside this machine, it is old age. So Spivey did the simplest engineer's move imaginable. He pulled out a map and asked one brutal question. What is the straightest possible line between Chicago and New Jersey? The answer cut straight through the Allegheny Mountains of Pennsylvania. That was the obstacle. It was also the opportunity. What came next looked less like a trading strategy and more like a covert infrastructure project. Spivey founded Spread Networks in 2007. The mission was simple enough to explain in one sentence and hard enough to cost a fortune. Build the straightest possible fiber route between Chicago and New Jersey, about 827 miles. Less wasted distance, less latency, less time for the other guy to get there first. Construction crews signed non-disclosure agreements. Some workers were reportedly told they were building a government infrastructure line. Spivey himself drove Pennsylvania back roads to map the route mile by mile. That is how much the geometry mattered. To fund it, he got backing from former Netscape CEO Jim Barksdale. Reported cost? About $300 million. In 2010, the network went live. Round-trip latency dropped to around 13.3 milliseconds. That improvement sounds tiny. It was not. 3 milliseconds in this game was worth serious money. Reported clients were willing to pay around $300,000 per month for access. Because once a market rewards speed, speed stops looking expensive. It starts looking cheap. But even while that cable was opening, it was already being outclassed by a harsher fact. Fiber was never the finish line. Most people hear fiber optic cable and think that must be as fast as it gets. Light in a cable. End of story. Not quite. Light is fastest in a vacuum. Fiber is not a vacuum. It is glass, and glass slows light down. The cleanest way to picture it is this. A sprinter on open track is fast. That same sprinter moving through shallow water is still fast, but not maximum fast. In ordinary fiber, light travels at roughly 2/3 of its top speed. Microwave signals traveling through open air get much closer to the real limit. That is why firms like McKay Brothers started building microwave networks instead, not buried cable, towers. Tower after tower after tower, each one positioned so the signal could hop over the curvature of the Earth. By 2012, round-trip latency was down to around 8.5 milliseconds. So the $300 million shortcut through mountains became second best almost immediately. That is how brutal the race was. But microwave had a weakness fiber did not: rain. Heavy water in the air can absorb microwave signals. Engineers call it rain fade. So when storms rolled in, firms fell back to fiber. The mountain cable did not disappear. It became backup infrastructure for a faster, more fragile system. So here is the design trade-off. If you were building this network yourself, where would you put the priority? Absolute speed or guaranteed reliability? But getting between cities faster was only half the battle. The dirtiest part of the war was waiting inside the exchange buildings. Let us say your firm now has the fastest route between Chicago and New Jersey. Excellent. You win the long-distance race. Then, your signal reaches the exchange data center, and now it has to cross the room. That sounds trivial. It is not. When the game is measured in microseconds, the last 100 meters can undo everything you won on the corridor. This is what colocation solves. Colocation means putting your server inside the exchange's own data center, not nearby, not across the road, inside the building, sometimes effectively on the same floor as the matching engine. The New York Stock Exchange facility in Mahwah has reportedly charged somewhere in the range of $10,000 to $20,000 per rack per month. And then comes the cross-connect, the physical cable linking your server directly to the matching engine. Even that cable length matters. 10 feet is faster than 100 feet, so exchanges standardized the length. Same cable for everyone, extra loops coiled under the floor, latency equalized literally down to the inch. That sounds like fairness, and in a narrow technical sense, it is. But here is the part people slide past too fast. The exchanges are not standing outside this race trying to calm it down. They are renting out the racetrack. They sell the space. They sell the connectivity. They sell premium data. They make money because the speed war exists. So the exchange is not just referee. It is landlord, toll road operator, and infrastructure vendor at the same time. And once everyone was standing almost equally close to the engine, the next weapon was obvious. Act on the slow order before it can finish arriving. Now the story stops being abstract. A pension fund wants to buy 100,000 shares of Apple. That sounds like a bland institutional order. It is not bland money. It is retirement money. Teachers, factory workers, ordinary savers, people who will never see the microwave tower that is about to step in front of them. The order gets split and routed. Part heads to Mahwah, part heads to Carteret. Both leave at almost the same time. They do not arrive at the same time. Let us say Mahwah gets the first piece roughly 2 milliseconds before Carteret. A co-located, high-frequency trading firm sees that buy order hit. Instantly, it infers what is likely still in flight toward the next exchange. Then it sends its own signal over a faster path, often microwave. It reaches the other exchange first, buys the available shares at the current price. And when the pension fund arrives a moment later, the cheaper shares are gone. Now the pension fund pays the new price. The fast firm keeps the difference. That is the mechanism. You can argue over the label: front-running, latency arbitrage, legal edge extraction. Pick the phrase you like. The economic shape is the same. The slower order gets leaned on by the faster one. This is why the Virtu statistic hit so hard. Across 1,238 trading days between 2009 and 2013, the firm reported exactly one losing day. And it is why Flash Boys landed like a grenade in 2014, because suddenly the public could see the machine instead of just the stock quotes. Brad Katsuyama's counterattack at IEX was almost absurdly simple. Do not try to outrun the fast firms. Slow everybody down a tiny bit. So IEX put a 38-mile coil of fiber in front of its matching engine, the famous magic shoebox. Every order had to pass through it. Delay, about 350 microseconds. That tiny delay gave the exchange just enough time to update prices and close the window. When the fast signal burst out of the coil, the opening was gone, door shut. Here is the real twist. If one box of coiled fiber could blunt $1 billion speed advantage, then the deepest problem was never just the laws of physics. It was the incentive structure built around those laws. If this is helping you see the system differently, if you are starting to see the machine beneath the market, subscribe. It helps the channel grow and allows us to build more of these breakdowns. So where would you place the first real constraint? Speed, routing, or exchange incentives? And once the race got close to the ceiling of physics, it did not end. It simply moved deeper inside the machine. By the mid-2000s, the intercity race was running out of universe. Microwave networks were already moving at roughly 99.97% of the speed of light in air. There are not many free winds left after that. So the war moved inward, into network cards, into switch design, into logic pads, into field programmable gate arrays, chips that run specific trading logic directly in hardware instead of waiting on slower software layers. Now the fight is not over microseconds, it is over nanoseconds. A billionth of a second, the kind of number that sounds fake until someone builds a business around it. And there may be another reset coming. A technology called hollow core fiber pushes light through a tiny, mostly hollow channel instead of solid glass. That means cable with some of the speed advantage of air. If that scales, the arms race will not calm down. It will reboot. But step back and look at the machine as a whole. After all the towers, tunnels, racks, coils, cross connects, chips, and routing tricks, what has the ordinary long-term investor really gained? Not clearer price signals, not a simpler market, not a calmer system. Mostly, this is a zero-sum fight over who gets to skim the time gap first. High-frequency trading firms account for roughly 50 to 60% of US equity volume. That tells you how much of modern market traffic now passes through this machinery. And the most reliable winners may not even be the traders with the fastest models. They may be the people selling access to the battlefield, the exchanges, the network builders, the infrastructure owners. That is the real shape of the system. The market no longer looks like one neutral place where buyers meet sellers. It looks more like a high-speed industrial corridor wrapped around retirement capital, with toll booths at every critical junction. And once a machine is built to reward timing edges, it develops a powerful instinct to keep rewarding them. Did this system become more efficient, or did it simply become better at hiding who pays for the speed?